In January 2021, one of Wall Street's most respected hedge funds lost more money in 3 weeks than most companies make in a decade. The company that took them down wasn't a smarter fund or some genius trader with a secret formula. It was a struggling mall video game store that everyone assumed was already dying, and an army of random strangers on the internet with nothing but a phone, a login, and a grudge. This is the story of how a bet against GameStop turned into one of the biggest financial blow-ups in modern history, and how the people who caused it never set foot on Wall Street.
Let's start with GameStop itself, because on paper, this company looked finished. It sold physical video game discs in stores, inside shopping malls, at a time when everyone was downloading games straight to their console or PC. Foot traffic was dying. Rent was expensive. Blockbuster had already been buried by this exact same shift, and GameStop looked like it was standing in the same grave, just waiting for someone to fill it in. Wall Street agreed. In fact, so many professional investors were convinced GameStop was doomed that they didn't just avoid the stock, they bet actual money on its death. That bet is called short selling, and here's how it works, explained simply. Imagine you borrow your friend's bike and immediately sell it for $100. You're betting bikes are about to get cheap, so later you can buy an identical bike for $40, hand it back to your friend, and pocket the $60 difference. That's a short. You borrow something, sell it, and pray the price crashes before you have to return it. A hedge fund called Melvin Capital, run by a manager named Gabe Plotkin, did exactly this with GameStop, and they weren't shy about it. At one point, the number of GameStop shares that had been borrowed and shorted was actually larger than the number of shares that existed. Picture 10 different people selling the exact same used car, and every one of them now owes a car back to somebody. That math only works if the price keeps falling forever. But someone was watching, and he didn't work in finance. A regular guy who went by the username Roaring Kitty had quietly put a huge chunk of his own savings into GameStop years earlier, convinced the dying company story was overblown. Nobody listened until he started posting his account screenshots on a Reddit forum called Wall Street Bets, a corner of the internet mostly famous for reckless bets and rocket emojis. At first, people mocked him. Then a few of them actually did the math on those short positions and realized something explosive. If more shares were shorted than actually existed, every single one of those short sellers would eventually be forced to buy real shares back, no matter how expensive they got. It wasn't a rumor. It wasn't a conspiracy. It was a mechanical trap sitting right there in the numbers, and thousands of strangers online had just found the trigger.
So they pulled it. Regular people, students, nurses, guys posting from their lunch break, started buying up GameStop stock together. Not because they'd all done deep financial research, but because they'd spotted a flaw in the system and wanted to watch what happened when they leaned on it at the same time. And what happened next is where this story stops being a stock market story and starts being a physics problem. This is called a short squeeze, and it works like a trap that feeds itself. As GameStop's price started rising, the hedge funds who'd shorted it began losing money fast. To stop the bleeding, they had to do the one thing that made everything worse: buy back the real shares they owed immediately. But buying pushes the price up even further, which forces the next wave of short sellers to panic and buy too, which pushes the price up again. Round and round it spins, faster each time, and almost nothing can make it stop once it's moving. GameStop stock, sitting around $17 just weeks earlier, doubled, then tripled, then stopped being funny. Elon Musk tweeted a single word, "Game stonk," with a link straight to the Reddit forum, and the price rocketed even harder. By the end of January, shares that professional hedge funds had bet would go to zero were trading above $300. At the very peak, GameStop briefly touched nearly $500 a share. A company nobody had faith in had just gone up more than 2,000% in under a month, without changing one single thing about its actual business. For Melvin Capital, this wasn't a rough month. It was a 5-alarm fire live on television with their name on it. In January alone, the fund lost more than half its money, gone, and they were staring down something called a margin call, which is really just your lender calling and saying, "Pay everything you owe right now, or we'll take it from you by force." Left alone, Melvin might have collapsed completely, taking a chunk of the financial system down with it. So two other giant firms, Citadel and Point72, rushed in with an emergency $2.75 billion cash injection just to keep Melvin standing upright. This wasn't generosity. It was damage control. And then came the twist nobody was ready for. Robinhood, the trading app millions of these small investors were using, suddenly froze the buy button on GameStop. You could sell your shares, you just weren't allowed to buy anymore. Overnight, an app that had built its entire brand on the slogan, "We're making investing accessible to everyone," told regular people they couldn't play anymore, in the exact middle of the game, while the professionals on the other side were still allowed to trade freely. Retail investors were furious. Hashtags exploded. Was Robinhood secretly protecting the hedge funds? The real answer turned out to be messier. A technical cash requirement behind the scenes, not a secret handshake, but the optics were brutal. It looked exactly like the house changing the rules the second the house started losing. And millions of people were never going to forget it. Congress didn't forget it either. In February 2021, the CEOs of Robinhood and Melvin Capital sat in front of lawmakers on live television, right alongside Roaring Kitty himself, all trying to explain what had just happened to a country that was equal parts furious and fascinated. Gabe Plotkin insisted Melvin had never been targeting small investors, that it was simply a normal bet that went catastrophically wrong. Roaring Kitty, the guy who'd started it all from his own living room, calmly explained he was just one individual who liked a stock and had never told anyone what to do with their money. But telling Congress you didn't mean to blow up a hedge fund doesn't unblow it up. Melvin tried to claw its way back through 2021 and never really managed it. By 2022, after another year of steep losses, Melvin Capital shut its doors for good and handed back whatever money was left to its investors. A fund that had once managed over $12 billion simply ceased to exist, taken down by a video game store and a Reddit forum it had never bothered to take seriously. Here's the part people love to leave out, though. This wasn't a clean underdog story where the good guys win and everybody goes home happy. GameStop's stock eventually crashed back down from its insane highs, and plenty of the same regular people who'd piled in near the top at $300, $400 a share held on too long, believed the rocket had no ceiling, and lost serious money when gravity finally showed up. Nobody was purely a hero here. It was messy, expensive, and occasionally reckless on both sides. What GameStop actually proved was something Wall Street had never really had to plan for. When enough ordinary people decide to move together at the exact same moment, in the exact same direction, they can shake a system that was built assuming they never would bother. For one wild month in 2021, some of the most sophisticated investors on the planet learned the hard way that markets don't only belong to the people who understand them best. Sometimes they belong to whoever simply refuses to let go.